Good morning, traders. It's CPI today. Morning, Kay. Morning, Dale.
Hello, good morning. How are you?
Good morning.
Well, good. Bit of a quiet morning. Everyone's treading water. I thought we'd forget the market stuff and have a quiz instead.
Yeah, what kind of quiz?
I don't know. Food, cars, music, and beaches you've surfed in your life.
Yeah, it is quiet today, but big number coming up.
Yeah, let's hope it's the calm before the storm and we get a bit of volatility later on. God only knows what happens if it all comes out in line. Everyone's going to go back to sleep again.
Yeah.
It'll be what it will be. You all right, Kay?
Yeah, all good, mate. All good, mate. We drew
Good.
at Real Madrid last night, so I'm hopeful for the return game.
Yeah, it wasn't a bad game last night.
Oh, two great goals, right?
Yeah.
Oh,
Yeah, very good.
class. Yeah.
And a bit of niggle in the middle. So all good. All good fun. Yeah, I've got my game tomorrow for the prestigious European Conference League.
It's a cup, mate. It's silverware.
Exactly. Well, we've got to get there first. Anyway, that's for tomorrow. Let's concentrate on today. Let's crack through some headlines, and then I think Stell's probably going to bring us some magic, hopefully, from the charts.
I wouldn't call it that, but yeah, I'll have a look at charts.
It is magic, mate. It is magic. Right, let's start with the good old Riksbank. And Floden says we are probably approaching the end of interest rate hikes. The scope to take smaller steps with interest rate increases. Wants a stronger Swedish krona, but have no clear tools, which is a bit of comment leading on from yesterday's similar comments made about the exchange rate, but apparently they've got no tools to address that. Not that I think they would use anything like intervention, but they definitely want it down. So maybe we need to be on watch for some higher jawboning to come on that one. Also says he personally doesn't see a rate cut happening under a reasonable time ahead. Any thoughts on that, Kay, and particularly comments on the SEK? That'll be a no then.
No, I'm here. While reading that, I had the image of a turtle on its back on its shell and wiggling its feet, trying to get back onto its feet. But more than that, what can we say about it, right? They feel a little helpless. I mean, intervention would be really the measure of last resort. In their case, but it's like everything. I mean, there's a 95 or whatever % chance they don't, but we can't discount the 5%. But yeah, for the time being, it's just trying to massage the markets a little bit, perhaps.
Yeah, exactly. Okay, moving on to the ECB, and Wojcik says our job on inflation isn't done yet. Need to see a change in core inflation. Nagel said interest rates should continue to rise, but we may be coming to the final stretch of rate hiking. It could have gone for a bigger hike last week, but the smaller step and balance sheet reduction was the right move. ECB Schnabel says that inflation momentum remains high for all components except for energy. Core inflation hasn't seen a turnaround like headline inflation. No doubt we will have to do more to bring inflation to target soon. Can reach a sufficiently restrictive rate with 25 basis point steps. Stell's mate, ECB Stornomas, told a Greek newspaper, as things stand now, we can say that interest rate rises will be over in 2023. And Lagarde was out with a interview with or comments via the Nikkei, saying pretty much the same old stuff she said at the presser, but she also reaffirmed that we have a mandate which assigns us to one objective, not two, like at the Fed. Our objective is price stability. So more comments there that they're prepared to hike even if there's some negative economic fallout from that. What's notable about all this is that it really is a raft of ECB hawks coming out. They're really pushing the script that we got from the ECB last week, but the market seemingly doesn't give a monkeys as far as the euro is concerned. It's still remaining on the back foot, not even looking like bouncing anywhere near to those highs. Yes, there's probably a bit of debt ceiling stuff on the US side in the mix with that as well, and everything else that's going on. But on the monetary policy side of things, it doesn't look like the market is going to be buying euros significantly anytime soon on further ECB rate hikes, unless it seems that they're going to be forced to go higher than maybe one or two more that they may have in the pipe. So that's the way the price action is looking at the moment. The euro is looking more rally seller than dip buyer, but we are still keeping above level, so there's no collapse yet of the trends, and we'll look at that in a bit more detail. Over to the UK, and the Financial Services Minister Griffiths said that the government will not change the BOE inflation target. That's something that's come up now and again in conversation about, well, around a lot of central banks where they need to change their frameworks and targets for inflation and so on and so forth. Not averse to some of them moving the goalposts to fit their agendas. Over to the US, and Fed Williams says he's confident that the Fed is on the right path to lower inflation to the 2% target, and is very focused on the impact of tighter credit conditions on the economic outlook. On that front, you need to pencil in the 15th of May, because the New York Fed is going to release its Q1 2023 household debt and credit report. And as that's the buzzword for markets at the moment in determining what the Fed's going to do, those types of reports, like the loan survey data from the Fed yesterday, is going to be important to keep an eye on. So 15th of May is when the New York Fed will release that. We'll see if there's any cracks appearing there. Back to Williams, he said, we'll monitor data to determine what's next for monetary policy. The Fed has not said it is done raising rates and doesn't see any reason to cut rates this year. Onto the debt ceiling tennis match that's going on. So old Biddy and his crew met up with other leaders, and US House Speaker McCarthy said from the meeting that he didn't see any new movement and hopes that Biden is willing to negotiate over the next 2 weeks. Senate Democrat leader Schumer said that McCarthy refused to take default off the table. Biden came out after the meeting saying that he finished a productive meeting on a path forward of the debt ceiling with congressional leadership, and we're going to continue our discussions and we'll meet again on Friday. He's not ruling out a short-term debt limit increase. So a mini can kick to Friday for these negotiations. As largely expected, nothing to come from this one. It was the usual saber rattling, everyone putting their chips on the table, and then we'll get the chess pieces moving around over probably many more meetings to come. So for now, the market may be a bit taking a bit of solace that they're sitting down and talking as opposed to not. But we're still, as I say, in this ping pong game where both sides are going to push their own bits and bills and stuff until we get to the 11th hour and they actually agree something. So expect this to continue, many meetings to come. Geopolitics, Italy says that they intend to exit China's Belt and Road Pact due to fraying ties between them. So further divisions coming in there. So yeah, a bit quiet all round on the headline front. That's all I've picked up as any sort of rough important comments. You guys seen anything swinging through the wires?
Yeah, I've noted just a couple of other things. It's not like, well, it may be in part responsible for the sterling perhaps keeping up a little bit now, is that there was a pretty decent report there on the UK wages catching up on inflation, but then on the other side, it's been there was a lesser a positive one saying that the increase in labor market is now mainly part-time jobs compared to full-time jobs. So the one balancing the other one out again. But one of the reports was pretty upbeat on the wage rises in the UK. So since it's something that central banks are looking at as well, is that maybe keeping just the positive undertone of the sterling right now. And then the other one is Ueda confirming my view on being the big new communicator, right? He was out again overnight saying that it's a bit too early now, but they will debate the exit and the changes and perhaps less ETF buying as well. But they will tell it all in a timely manner to the public. So he confirms really his initial, at least, thoughts about him being the not the big reformer, but the big reformer can be. But at least he's the new big communicator, right? So and that I think is slightly perhaps countering what he was saying yesterday about talking about exits and stuff, saying that it's a bit too early. But yeah, he's likely going to want to avoid shocks in the markets, because they, as enough people have already been commenting about that, a big change in the Japanese monetary policy will have ramifications for a lot of markets. So he is really telling us that he wants to avoid any of those shocks coming forward. So he's going to be already in my the first leaf of his history is the big communicator.
Yeah, and talking back to the pound and the UK stuff, it's not really a surprise. We've been banging on about these wage gains potentially being in the pipeline from all these strikes and getting resolved and stuff. We still do have a few strikes knocking around, teachers, rail unions, that sort of thing. So there's still plenty more on the wages side that's going to come in. But talking about the pound, the list of those more positive include Goldman, Citi, NatWest, Barclays, and Bank of America, who are apparently all more constructive on the UK and the pound. And but Deutsche Bank have just popped up saying that it no longer thinks the pound is attractive in the short term, and they say they're taking profit on some position they had in cable after the recent rally, and sees potential dovish risks at the BOE meeting tomorrow. So not everyone's bullish the pound, but a big crowd getting a bit bullish.
They've all been listening to my comments on the flow show.
Exactly.
They're all late. K was first.
They're all late. You know where you heard it first, folks.
Exactly.
And our forecasts knock the bank's forecast out the window. As you say, as we've been talking about these UK wages, been touting that for months, and now everyone's picking up on it. So anyway, yes, good little pump for us. Anything else, guys, before we get stuck into some prices?
No, I think,
well,
not really. My side.
Not your side. Cool, good stuff. Okay, well, let's have a look at things. As I mentioned, the euro, not really getting any sort of benefit from these comments from the ECB, even from Her Majesty Queen Hermes herself. So what we have had is a little bit of a bounce off support down into this 109.40 area. Been a bit of a support area of late. That trend line you can see there comes in from the 2016-2020 area, which I will show you quickly there. A little bit unclear, but that's that line there. So we're just that's right in the mix on that too, and that's obviously coming in ahead of the 109 number as well. So a bit of a test of the downside here. It's held in the first instance, but the bounce has been I wouldn't say it's strong at all, and we're coming down again. So we may be looking at having a bit of a break lower here, maybe testing that 109 area. Nothing is really. We've had a big move off of 111, obviously, but nothing is creaking or breaking. We've got two real trends in play at the moment. We've got the March leg of the wider trend here, and the 38.2 isn't down until the magic 108.70s area, which is a big traffic zone that I've had on my chart for years and years. But that is all that leg is part of the bigger leg, or the bigger trend down from the September rally all the way up here, and the 38.2 of that isn't down till the 104s. So even though we've got this coming off the top here, there's no reason to suggest that this trend is for changing in any way, shape or form just yet, unless we start breaking some of these shorter term levels. So if we hold this low area down to the 109s, we're probably setting up for a bit of ping pong between there and 111, with 110 as your pivot area. So pick your poison, trade where you want, pick your levels in between. You will find little levels, 110, 50, that sort of thing. But for me, it's going to be a case of looking to trade the wider range. I was hoping we might get a move down to closer to 109s to pick some up for a tech test, but we never got that far. So I was being too picky, but we'll wait and see what happens here. Euro sterling, another one, which I started taking some longs up around here, and it's not looking too hot at the moment. Again, we've hit a traffic zone down here. Let me come out a little bit for you guys. So this has been an area that's been a former traffic zone, and we're just holding that for now, but it's not looking too hot for euro sterling at the moment. Bounce is very weak, not even really putting in a test on 87. So these longs might be of mine, these short-term longs might be put to the sword not too long. I do have a core position. The lowest entry is 86.20s, so I may decide to do something if we break under this zone. Look to get out, maybe cut that position and see if we get a move down to these 85s, where I might look to build again. It's funny because I'm not bullish the pound, but I can see plenty of reasons why the pound is bullish, particularly going into the Bank of England. So this is one of these ones where the situation, I know the situation is the pound's stronger, and reasons for it being stronger, even though it's counter to my positioning. So I need to decide what I want to do with that one there. Dollar China, still looking to take a bit off 93.50. We did get up there this morning, but spreads and everything didn't quite get to my profit target to take a bit more off at 93.50. We are still holding above this 91, and if we can get back above this line here around 93.80, 94s, we should get a kick on back up towards the 96s. I saw you mention that in the room, Kay, that you're looking a bit more bullish about this one again.
Well, yeah, I stepped out of it like, what is it, a week ago or so? And since then it's been like rangy, but I saw something overnight mentioning that dollar-denominated Chinese debt is not feeling too well right now. It's a bit of a sputtering reopening as well. I am trying to be patient to wait until the CPI this afternoon, but I may think of re-entering there a little bit if the data coming out are dollar positive, and dollar positive, mildly dollar positive. It's going to be, and perhaps straight away throw it in there. To me, this afternoon, those numbers are going to be whether it's going to be a hold, a mild move, either way. The extremes, the strong beat or the strong weakness could both end up being bad for risk, but or bad for risk, or bad for the dollar in the end or so. But it's all going to be, to me, the better trade this afternoon, the easier trade this afternoon is going to be one not too far from where we are now. But we'll talk about the CPI perhaps a bit later.
Yeah, certainly. So let's have a look at what's expected from the CPI. So headline CPI is expected in unchanged at 5%, and the all-important core is expected to dip a pip to 5.5%. So this is going to be pretty easy to trade. Okay, if both head lower, then that's going to pause trades further. So the market will be expecting the Fed will not be raising as much as perhaps they have been suggesting, maybe 1, 2, 3 more in the pipeline. So if both move lower, then that's going to add to those. And we'll probably see the dollar coming down a bit and yields coming down as well. Now, if the headline drops and the core goes up, then that's likely to see yields rally and the dollar rally, because the market and the central banks are all about the core. This is the important one. The headline number takes into account all the quick moves in energy and that sort of thing. The core is obviously what happens at ground level. So those sticky prices that don't come down as quickly as the other volatile elements. Now, if they both go up, well, probably going to see a bit of poo hit the fan, folks. That's going to change around the pivoters. They're going to be running for the hills, and the market hawks are going to probably come steaming in, lifting the dollar much higher and lifting yields as well. For something like dollar yen, we're probably talking 136 in a pretty quick trip. And I wouldn't be surprised if it even goes through 136 on such a scenario. But also look at the variation. If it's just a 1 pip difference, that may be enough for a strong reaction. But if it's anything stronger, 2 pips or more, let's say over or under, that's my usual rule of thumb for inflation, then that's where you'll get a more stronger move in the dollar. Okay, Dale, what are your thoughts on today? Anything particularly on the move front you're looking for, or directions?
Well, it's difficult to predict, right? I mean, it's I don't like predicting that much, but I will go with the recent trend of the past months, which is for inflation to come in slightly softer than expected. Core has been stickier. I think core, as you correctly said, is getting more important now. I tell you what, I think there's going to be a pretty big move if inflation starts ticking up, because then I think the market will have to take out a lot of the cuts that are priced in, because even if inflation starts ticking up, even if the economic environment starts worsening, even if we get to a kind of mild recession, with inflation ticking up, would the Fed be cutting rates? I don't think so. The mandate is employment and inflation. Theoretically, they should be fighting that. And if there's a recession, if equity markets correct a bit, well, that's not their mandate. Of course, we know they care about that. But I really think if inflation, the trend has been to go lower so far for the past 6, 7, 8 months. That trend needs to continue for doves, for people who think that, the Fed's going to pause and they're perhaps going to be cutting later this year. If that trend stops, then there's all sorts of trouble. Having said all that, I do think that we're probably going to get a slight miss on inflation. So, we're expecting 5% and 5.5% for core. I think 0.1, 0.2 lower is the most likely scenario. The question is, will we get it? Of course, I don't know. If I knew, I'd be a billionaire. But if I knew, I'd be Ryan. But no. So that's my assessment. And I think the market move is going to be a lot more violent if we get a higher than expected CPI reading, because that will mean that it's going up now instead of going down.
Yeah. What did you make of Bidenomics overnight as well? We spoke about inflation.
Inflation is 40% lower now than it was 6 months ago, something like that, right?
Yeah, exactly.
I mean, that's ridiculous. Just even saying that is just. I mean, I don't know who approved that for him to say it, but you just can't say that. It's. But as I've said so many times, even if inflation prints at 2% in 4 or 5 months' time, is that success? Of course, it's not. High prices are here to stay. They're baked in. You don't want that. You want prices to go back to broadly where they were, because we had a huge spike in inflation. You can't say back to 2% year on year and everything's fine. No, you cannot. You cannot celebrate on that. But, you bet your ass they're going to be doing that.
Yeah, exactly. I mean, there's still people asking if inflation has peaked. Well, it peaked 9 months ago. That's clear as a nose on your face. But look at last month's release. It came from 6% to 5%. That's a huge move, and we're seeing a lot of volatility in inflation numbers. But yeah, these are still, as I keep pointing out, these numbers are still gains. So this is still higher than last year. and last year it was up here. So, you know, we're not going back. Prices aren't going back to where they were 2 years ago.
I think many people mistake prices with inflation. People say, "Oh, high inflation is here to stay." I kind of disagree with that. I think high prices are here to stay, and that's exactly what you are saying, I think, as well. So
yeah, exactly. I mean, it's the nature of the world. It's like, you know, a loaf of bread was 10p when my parents were kids, and now it's £1.40. You know, inflation happens. It's continuous. Doesn't matter, even when you get little deflationary cycles, prices will keep going up over time. So even if inflation spends the next 3-4 months coming down and gets to 2%, fine. We're still, I don't know, 8-9% higher than we were a year ago. You know, so that's people thinking that we're going to get prices back to where they were a year ago. It's a fallacy. It's not going to happen. Everyone needs to get used to the fact that you're going to be paying more for your stuff. But then that's reflected when people look for wage increases, and then people get higher wages, and that adds to the inflation spiral. It's an infinity loop in effect. But the central banks work on numbers, and if they're happy to have inflation running at 2% forever, because that keeps wages in control, that keeps inflation in control. It's just, as you can see, over the last God knows how long, they have zero control over what inflation wants to do. So good luck on that front. But that's a whole different argument. Kay, what are your thoughts for today in terms of possible reactions?
I don't disagree at all. I mean, yeah, we all look at core, of course, but then we all know that there's a lot of numbers crunchers in the market, and even the headline, if you start to print a 4, that may be seen as a positive development, right? So the core will take longer to get down there. But if you start to have like a 4 in front of the headline CPI, it may already have like a small impact. What is going to happen? I think we can do this continue this slower slope lower. It's what we've been talking about, what Stelios was mentioning, Q1, Q2 this year should see an acceleration to the downside, but it's a slower slope, but the slope is still there. So I pretty much agree with that consensus. Yeah, okay. I last month was a bit of a change, right? But I think the overall move, it looks like coming in a few waves there, right? The overall move, I reckon, especially if you look at main prices also, they are coming just a tad off. So, but it's more about how to trade what's coming out than really having that number. The variation is one thing, but if the core really continues to be sticky, then again we are talking about having to reprice expectations, and that's what's going to be a big driver today again. And it's going to drive probably everything this afternoon, whether it be the dollar as such, whether it be well, for sure the bond markets, equity markets, metals, and the risk profile. We've been seeing quite a few moves on euro crosses, on yen crosses lately. The euro crosses have been more driven, I think, by positioning than really trying to put in a new trend. The positioning was very positive euro, and that has been now should be kind of corrected and back to more normal levels, but we'll see on the next set of numbers. But yeah, it's going to be a mover this afternoon, right? Whatever happens, because there's enough model funds, enough expectations in the yields and in the curve and whatever to see things move. So yeah, whatever happens, it's going to move, and then we have to look at the scenarios.
Exactly. But on the other side, just going using euro dollar as an example, you know, perhaps we shouldn't expect too much from something, even on big numbers, because, you know, we've come through the ECB, we've come through the Fed, we've come through NFP, a whole lot of big events, and we're stuck in this 200 pip range. Now euro dollar may be the outlier, being the most liquid pair compared to some of the others, but again, pick your poison. If you're looking for a big move, you may not get it in something like euro dollar, or if you do, it may not last and then revert back to mean. But pairs like dollar yen are going to be very reactive to those yields. So this is where you may get a bit more bang for your buck. And maybe even in cables, the opportunity. The market is bullish to pound. Anything that sends cable lower, that's dollar positive, you've got to think that might be a trade to look at for a counter, because with the Bank of England tomorrow, market's going to keep those expectations on the table for the pound. It might be a dip buy worth looking into. Just be careful you don't run into a quagmire tomorrow where price does nothing waiting for the Bank of England. So if you can grab a quick one in that one, jump on a dip, get a good 30-40 pip rally, take some money off the table, because it may just go sideways into the Bank of England, and then you've got that risk tomorrow. Stel, your turn.
Sir.
To make it what?
Yes, sir. Sir, yes, sir.
On you go, sir. Soldier.
Let me take the screen. All right, so it's going to be an interesting day, hopefully today, with CPI. As I said before, I think the reaction on a higher than expected print will be stronger than, or more violent, let's say, than a weaker print. So 0.1, 0.2 lower is going to bring a smaller reaction than 0.1, 0.2 higher on the year on year. I think that's my assessment. So yields, let's start with that as always. Kind of stuck in a range here. The support is still very clear, 327. Those lows, 326, whatever that was. And highs, we have this 360-ish, which was the high. It's also a fib. So we're kind of stuck between those two. I think that on a strong number, so on a high inflation print, I would look at short-dated US bills, so 6 month, 1 year. Look at what Fed fund futures are pricing. So we have May Fed fund futures at 94.95. So that's a roughly 505, just above 5%. And then if you go 6 months out, we're pricing more than a cut and a half. And if you go 1 year out, 96.29. Oops. So that's more than 1.25. 1 year out. So I would say, because as I said before, I think if we do get a higher than expected inflation print, I think some of these cuts have to be taken out. I would look at 1 year. We're near these highs here, 5%, nice big number as well. I think that's going to go, it's going to break out, and I think that has a nice potential. So I think shorting 1 year or US 06M 6 months, again, 6 months also close to the highs, plus shorting that gets you a kind of a free option for the event that, God forbid, we get some kind of shenanigans with the debt ceiling and, people start defaulting. I don't think it's going to happen, but you know what I mean. So I think these two are probably nice plays as risk reward in terms of for a strong number, stronger than expected number. But the 10-year, that go on.
Yeah, just back on those shorter end that you're looking at. I mean,
Yep.
you would laugh if you got a strong number today and you sell that one, and then the debt ceiling gets sorted out. There's going to be a double push on the yields, right? So that would be a big laugh for you.
Well, all sorts of things can happen, but yeah, I think as a risk reward. But
I mean, you got a double push on that. Then.
Yeah.
Because if the debt ceiling gets arranged, I mean, that means Treasury is going to issue more debt, and that's going to push your rates even higher.
Yeah, and for me, absolutely right. For me, the main play is these cuts, which are priced in, which I think are a little bit too aggressive for now, especially in the next 6-7 months. Yes, even if a recession comes. As I said before, if inflation is not going sharply lower, I find it hard to see how they're going to be cutting. Then again, I could be wrong. I've been wrong many times in my life. The main thing is to accept when you're wrong, cut the trade, and then move on. But for the 10-year, it's a different story because it moves based on a lot of other things. Flows tend to move the 10-year a lot more. You know, I've said this a million times. I used to sit next to the government bond traders when I was market making interest rate swaps, and man, the flow just pushes things around in a big way. Anything above 5 years is 80-90% flow. So you know, I wouldn't put too much emphasis on what's priced into, let's say, the next year for the Fed on the 10-year yield. That can move, you know, any which way you like. Anyway, so the you know, the 10-year yield is kind of trapped in the middle. Unless we break either side, I'm not really interested on that. Now, the big question is what happened with risk in either scenario. Theory would say that a higher inflation number should bring upward pressure into rates, which means downward pressure to stocks. This has kind of not been the case for the past you know, couple of months. You know, we get some good strong numbers and equities go up. Classic example was payrolls last week. I guess that if we do get good numbers, it means that a recession might be avoided, and the main danger here for equities is a hard recession, you know, a deep recession. That will, I think that's the only real scenario where equities drop significantly from here. Because, as we've said before, money supply keeps expanding. Yes, okay, there was a contraction last quarter. I think first contraction in, you know, 40 years, whatever. I don't care about that. The main picture is that the Fed and the you know, the U.S. Treasury needs to borrow every year more than $1 trillion more, $1 trillion more. And the same with the Bank of England, the same with the EU. You know, all the major banks have deficits. As long as that's the case, money supply will keep expanding, and hence anything denominated in dollars will have to go up in the medium term. As I said before, what do I think is a scenario where equities go down, you know, more than, say, 5-10%? I think a strong recession would be a trigger. But for now, I still think this chart looks bullish to me. And we are close to these highs, 4,200. I've repeated this every day. If I was short the S&P, I would be really worried. We just, with everything that's happening, we just cannot seem to have a sustained move lower, and that's worrisome for bears. Needless to say, if we get inflation dropping, I think that's going to push risk assets higher. Sorry, I don't know if you can hear my phone ringing. I'm not going to answer that. So yeah, the S&P and risk assets in general, it's a tricky one. I think barring a you know, outsized print in inflation, I think we probably grind higher towards 4,200, and I still think the pain trade is to go higher, break these highs, and then head towards 4,300. I think there's a lot of stops up above here, and you know, for the shorts, I fear that they're going to get triggered. So I don't have a position in this, but I tell you what, if we break above 4,200, I'm probably going to do a quick trade to buy the breakout with a stop below. I don't tend to do intraday trades or, you know, day or 2 or 3 day horizon trades, but I think on this one I'm going to try that. Okay, so currencies. The euro dollar is retreating. But I still think, because I think that the CPI will probably disappoint a little bit to the downside, I think these highs will probably get taken out. Similar story with the S&P. I think the path of least resistance is to go higher. The dollar, I think, will react a lot more directly than equities on the inflation print. So a strong inflation print, I think the dollar rallies. Weak inflation print, the dollar sells off. I think it's a lot more straightforward rather than equities. And I think Steve has been saying this on F.A.C.E in the morning edge. So a strong number, I think these lows get taken out. A weak number, man, we're going above 111. I really think we're going to be going above 111. And the ECB, yes, we had Stornaras, who is who said that the way things are going, a rate hike should be finished by this year. Well, yeah, I think that's possible, but the ECB has a little bit more to do than the Fed. And inflation in the Eurozone is higher than the US. And most importantly, the trend is not as clear as it has been for the US. So I think the path of least resistance for the euro as well is to go higher. I don't have a position in it. Now, if you want to be long the dollar, probably not a bad, probably not a bad level here. Nice risk reward. You will know if you're wrong on the inflation print. I wouldn't recommend you take a position before because you're just betting on the number. So I would say wait for the print and see what happens. But there are some instruments some pairs which are near breakout or breakdown levels. USD CAD is a really nice one. We tested this trend line once more to the pip. I mean, if I zoom in, it's exactly there. These touches have been amazing. Okay, 1, 2, 3, 4, 5 touches. So we're near these lows. If you want to be long the dollar, this is not a bad pair to be long. You know where you're wrong below here, obviously. So that's one which looks good. Dollar Norway does not look good because it's right in the middle, so I'm going to ignore it now, even though I have a short bias on this, but we're right in the middle, so don't really care about that at the moment. Cable has broken out for all intents and purposes. I am still bullish on this. When we broke out here, I said I think the bias is now bullish, and it still is. The big question mark is the Bank of England, and I worry about them because even though inflation is still high in the UK, higher than pretty much every other Western country. In fact, I saw a chart that said of the top 20 countries, I think only like Argentina and Turkey or something like that had a higher inflation than the UK. But as long as that's the case, they really shouldn't be pausing. The Bank of England, of course, they look at the 2-year horizon. They will say, "Look, we think they could say we think we've done enough for inflation to come down in 2 years' time." Who the hell knows what's going to happen in 2 years' time? So they could easily say that. I think it would be madness to do it, but the Bank of England always err on the dovish side, and they could do that. And I've seen a lot of or some bank reports saying there is a real risk for this happening. And even though it does make sense, I think I agree there is a risk. But cable remains bullish in my opinion. Europound is interesting. This we have broken. Okay, so we broke below these lows, and if for those who have been listening to the Flow Show for weeks and weeks, remember when we got close to 90, I had the target at 19 euro pound. We almost got it, and as we got that, I said, "Look, I think we're done now. My bias is neutral, and I think we're going to be, grinding towards the middle of this huge range, between 90 and 83, and this is what we're doing." We've broken below, so technically this is bearish. We could see a rally and retest if the Bank of England is hawkish. If the Bank of England is dovish, then we could see a retest here. But for now, I think this is bearish. Would I chase it? No. If we come back up towards this 87.2 level, probably not a bad idea to be trying a short. But at the moment, I wouldn't chase this at all. Dollar MEX is a nice one. Dollar MEX fell below these lows. Remember, we've been talking about this 18 to 1850. As soon as it broke below, this price action was actually quite interesting. Broke below, probably stopped a few people out, came back, stopped the people out who got short into it, and then stopped the other people out. I mean, this was just an incredible move here, but it's still looking bearish. And remember, you're still getting a very nice carry being short this. So my bias is still bearish for the dollar MEX. But, as I said before, for all these pairs, I would wait for the numbers. It doesn't matter if you miss the first part of a move. If the number is significantly different than expectation, then I think we're probably going to see a continuation on whatever move happens in the first, 5-10 minutes of the aftermath of the CPI. But as I said before, I think EuroCAD is probably the best. Sorry, dollar CAD is probably the best looking one. Metals, well, nothing changed. Gold still above about $45 off the all-time highs. Still looking very, very bullish. I mean, there's barely a retracement from this move from the low 1600s to the 2060 highs. Could a strong number bring metals lower? Yes, in the short term it could, although I find it completely perverse that this will happen, because if we have high inflation, it means that the price of goods is going higher, which means theoretically anything that's dollar denominated going higher. So, you know, would I be selling gold, silver, platinum on the back of inflation going higher because everything, the price of everything is going higher? Of course not. But you know how the market likes to move. I think if we do get a high print, metal is going to get smashed a little bit. That will be a nice opportunity to get long. Where would I get long gold? Tough call, really tough call. 2000, nice round number, but it's too close. I would personally wait for something like 1960 to get long, but I doubt we'll get there. I really do. I think gold is poised to break out to the upside. Yeah, that's that. Silver is a similar story in terms of being close to its all-time highs. Worse than gold, is almost down 50% from its all-time highs, but it is looking bullish still. Has broken out of the channel, consolidating now. I was hoping for a dip towards 2380, 24. Haven't got it, so I'm still 2/3 long. From a lot lower, which is nice to have that cushion, but I would really like to get a little pullback to fill up to whole position long. But you know, even if I do have a 2/3 long and full breakout, hey, I'm not going to say I'm sad about it. I wish all my trades went like this. So clear level is now 2610, 2612, whatever the high is, and we're not that far. So a weak number, I think, will push metals higher. Platinum broke out and retested, actually came into the channel a little bit, has broken out. I think platinum is bullish as well. But again, today's number is going to be important. Do not underestimate how violent a shorter move can be on a strong number, on a high inflation print, because that's what the market knows how to do. All the algos are hard-coded, hardwired. As soon as the dollar rallies, metals get smacked. So be patient. I'm going to be patient. If they do get smacked, I'm not going to get in it quickly. I'm going to wait. I'm going to give it a few days, see how the move unfolds, and then probably enter. But I'm going to wait for the market to come to my levels. I'm not going to be chasing. I'm not going to be FOMO'd into something. So that's enough for metals. Cryptos, tricky one. I will still call Bitcoin bullish because we have, we saw impulsive move and we're still correcting. We haven't seen a lower high yet. A lower low yet, although we have seen, this high here. We need to see a lower low first. We need to break below 26.9. We did touch this support trend line, but really the big number is those lows there. So 26.9, 27K. We're close. So if risk gets sold, this is dangerous. I still think this is bullish, but you have to know where to take the trade off. And I think it's below 27K. If you're long, that is. Ethereum is, I don't like Ethereum. It's not as pretty technically as Bitcoin. So I'm going to leave that aside. Oil, I have no clue what to do with oil. Seriously. Yeah. Help. I don't know. I haven't traded it in months and months. So I don't know is the answer.
I think all knows what it's doing with it right now. It's all just a bit messy, isn't it?
Yeah, and it's such a widow maker, this thing. I mean, gaps get filled left, right, and center. 5% moves on a day. I can't trade this. I really can't. Sorry. So that's it. I will leave it at that. And I'm going to reiterate: don't be hasty to get into trades. For God's sake, unless you have a really strong view on how this number is going to go or how the reaction to the number is going to go, I really wouldn't put a trade on before the number. It just doesn't make any sense to me. So be careful, size accordingly, and good luck.
Yeah, I think that's probably the best advice for today in trading the CPI. You know, if you don't have a position on already that you've got to manage, don't guess what it might be. You've got a 50-50 chance of being right, and you've got 50% chance of being wrong. So look at your levels, look at the edges, look at the ranges. If it's a big number, it has to break out of whatever ranges of whatever asset you're looking at. If it can't break the big levels, then it tells you what to trade, and you can lean against those levels. Just before I hand it over to the K-Man, I just want to share something with you guys, and let me get my screen back. And Stel, I want your input a little bit on this as well, because there's been some changes to the traders funding program, which you guys and girls know about. I'll put the link in the chat function there. So first thing that's changed, the main thing that's changed, is that we've raised the drawdown levels, whereas before they were at 4% and 5%, they've now been raised to 5% and 6%. Now this is for accounts, new accounts. We can't do, or guys can't do the calculations, any backward calculations on those, but those have been raised. Also, there is an option to take a higher profit margin. So under the old way, the standard was 75. You can take 90%. There's a little bit of an add-on to the initial cost for that one, but it does increase your share from 75 to 90. So there has been some change there. Positive changes, I think, still, for particularly on the drawdown limits, gives people a bit of extra room, I think, on that.
Exactly, yeah.
Is this jump in the profit share, can that be added to a current account, or is that just new accounts only again?
As far as I know, it cannot, but I need to check, actually. I actually need to check. I'm not sure. I need to ask our support staff, because I'm surprisingly not knowledgeable enough on that. I should know this. So,
yeah, no worries. But yeah, so if you were thinking of taking the TFP, you've got slightly higher watermarks now, particularly in those drawdown limits. Gives you a bit of room. Still need the discipline, but if you want to check out all the details there, the site has been updated with all those. I say the link is in the comment function here on the Zoom. So with that, Kay, did you want to have a look at a couple of choice assets?
Just looking at the clock, do I have a few minutes, or do you want?
Yeah, go ahead, mate. Go ahead. Short and sweet.
Yeah, it's going to be short. So we've been talking about those, or I've been talking about those euro crosses of late, and there's been quite a bit of reaction after the we did the top just above the before the ECB, that was right. Yeah, and there's been quite a bit of reaction. EuroCAD is not an exception, but they all reacted. We are on interesting levels here. We're already been testing this one, but as I said yesterday, and I'm going to repeat it here, and earlier on the show, if you don't want really to trade dollars, there's going to be enough moves on risk pairs. And positive risk, if we would get like a slightly weaker number, confirming or re-engaging the slope lower on the CPI, especially on the core, if that would come in a little bit lower, without really dropping away, because there may be other funky reasons for that. I think risk should be really doing very well. And then we have to look at this, what happens here at 146, 1545. We know that from the past, it's been like really a big traffic zone. So the short term is in the test mode, but the more medium term maybe coming into test mode this afternoon. So keep an eye on what's happening here. if ever this would go back below 145.80, 145.75, there's going to be a lot more to the downside probably. That's in case of a risk positive outcome this afternoon. If in turn we're seeing very, very sticky inflation and risk would get sold off, like that is yields higher, stock markets lower, weighing on metals, weighing on probably commodities, and probably weighing on perhaps oil as well. By the way, yesterday we saw a bit of a surprise build on the API last night. This could in turn have found its bottom and starting to move back up to this 148 initially, I'd say. So this is an interesting one to watch. And all those risk pairs are going to be an interesting watch this afternoon. Keep an eye on what's happening here in the Euro Aussie. Around 162 the figure is pretty easy. It's a daily one, so there are going to be intermediate levels, but keep an eye on what's happening. 161.90 figure, and then if that would go on a very positive risk number, we could be seeing it down to 160. I don't think 159 is on the cards. There's still a big move. There's still more than 2%, but I reckon some of those euro crosses now, we have seen the correction, and now we have to wait to get a catalyzer or a confirmation whether risk is going to continue to do well in case euro crosses tend to be a bit lower, or if risk says this is enough, and also look at this, the 55 DMAs over there, or if it's enough, and then all those euro crosses will have been a correction and we will start to move higher again. So pay very close attention to what risk is doing this afternoon. And the same one is going to be happening on the Euro Kiwi. Look at this Euro Kiwi. We're in the channel, broken out because of the euro being so damn beat, and then the last spike on just ahead of the ECB, and then bang lower. And we are trading below this support, but I think the main one today is going to be this 50% here, low 172s on the Euro Kiwi. Or if you start to go back into the channel, then the party may be to the downside, may be over. For the time being, I'm not in those I'm not in those crosses anymore. I played parts of not especially in the Euro Kiwi, but I did it in the Euro CAD and a bit in the Euro Sterling. Again, we may look here for a continuation of the downside for stuff like Euro Sterling as well. Broken a trend line here, and then we broke those prior lows, as Estelle was already showing. If you see a continuation of the positive risk environment, this one could eventually go, or possibly go and test low 86s even before the Bank of England tomorrow, and then we need to really reassess on what the Bank of England is going to do, but we'll talk about it tomorrow. But you're looking at risk pairs here, okay? If you don't want to trade dollars. If you start to go back above this 87, I think already 87.20, 25 will be already enough, because then you're going back below those, above those prior lows. I think above 87.20, then we are much more neutral and waiting for the Bank of England really. So that is few crosses where you can play your risk. Euro yen, in case we get a risk off number, the dollar will rise, but we know that, and that was my expectation as well for now, that UEDA is taking the helm. I think there's going to be much more risk being traded in yen again. Look, have a look at what's happening here. This is 147.5 going into this afternoon. We're about 60 points above there. This is your level, I reckon, to watch going into this afternoon. If we get a very negative risk number, that means a monster beat on the CPI. Dollar yen will shoot higher for sure, but crosses versus yen could actually come off. So watch out if we get a very negative risk number. So I was just going to wanting to show a few of those crosses. What can happen in the case of risk on, risk off? If we get a very good risk number, I expect on Euro Norway 1150 to come under pressure, or at least going for a real test. And then we'll know whether this has a 1120 signs or behavior, or if we can trade lower. Therefore, we are going to need help from Brent, for instance. So that's it. I'm looking at the time. I think I've shown enough there, and just showing the people of how I look at how to trade this kind of environment inside a risk on a risk move.
Thank you very much, mate. Much appreciated from you both as always. Right, so as far as the flow show goes, all the talk is done. For those of you in the chat room, we'll have plenty of other analysis and ideas popping up, no doubt, leading up to that CPI data. Thank you very much to everyone for coming to the flow show, and thank you to my two colleagues, Kate and Stel. Have a great day's trading. Be safe over the CPI, and we'll see you all tomorrow.
Cheers, guys. Thank you, everybody.